IT giant Infosys surges 3% and is the top Nifty gainer on the back of blockbuster first quarter earnings. The management also raises their FY25 growth outlook to 3 to 4% from the earlier range of 1 to 3%.
Persistent Systems is down more than 5% after margin disappoints in the first quarter. The constant currency revenue growth, however, was strong, above estimates at around 5.6%.
JSW Infra also slides close to 6% as profit declined 7% on the first quarter on the back of maintenance shutdowns. Margin has also dipped from 61% last year to 50%.
CEAT was lower in trade by close to 3.5% after delivering mixed set of numbers. The company reports decent revenue growth. However, the margins are down for the third consecutive quarter due to increase in input costs.
VSE Industries zooms more than 14% as the company says the board will mull to issue a bonus along with their results on the 25th of July. Hello and welcome. You're watching us here on Chartbusters on CNBC TV18. I'm Manglam Malu. With me as always, Nigel D'Souza. We'll talk about the markets at large, but first up, let's talk about the earnings. The stock on our radar is Havells India. The company reported a mixed quarter. Revenue was higher than expectations on a year-on-year basis. Margins in the non-Lloyds part of the business was a slight miss. We have Anil Rai Gupta, who's the CMD of the company, joining in now to discuss these numbers in detail. Thanks a lot, Mr. Anil Rai Gupta, for joining in and talking about these numbers on the whole. But let's start with Lloyds. That was, one of the stellar performers of this quarter itself, backed by, good seasonality, etc. as well. Now, with EBITDA margins in this quarter being close to around 3% the street is now looking at structural profitability of Lloyds. So if you could give us a sense of going forward, what is the kind of investment that you would make in Lloyds? And will there be structural positivity? If yes, what are the kind of margins that you're gunning for here?
Well, I think we've always said that Lloyd requires long-term investments, and that's what we have been continuing to do, R&D, manufacturing, brand building, distribution reach. So those are the fair, investments that we have made and will continue to make in Lloyd because we believe that it's a very large industry. Air conditioners is highly underpenetrated and it's at an inflection point of fast growth. So we'll continue to make these investments. Structurally, also, we believe that Lloyd has been making strides towards achieving efficiencies in manufacturing. So we believe that, and plus the brand perception, brand building, which will give us the right kind of pricing in the market as well. So we believe that we are on the positive trend, but we'll continue to make investments for fast growth in this business.
So the bottom line, Mr. Gupta, is that Lloyd continues to stay profitable, right?
I mean, quarter on quarter, it can vary because of seasonality, because still, even today, 70-75% of the revenues come from air conditioners, which is a seasonal product. But overall, structurally, there'll be a far better improvement over the past years.
Okay, that's good to hear then. If you have to niggle about these numbers, one factor would be the street was anticipating a little better margin profile. Do you believe on, put all your business together, Lloyd has turned it around, a couple of verticals did better, some of them a little bit softish. Double-digit margins should be what we should be working with, say in the vicinity of around 11% or thereabouts on an average for the year?
We actually look at, Lloyds, which is an investment business, and Havells separately. But Havells, we do believe that, depending upon quarter on quarter, otherwise we gun for at least 13 to 14.5% margin in Havells standalone. And Lloyd, as I've already explained, is now towards a positive journey. Again, quarter on quarter can vary, but it is on a much better position than what it was in the last couple of years.
All right, so 13.5% margins in the Havells business, and Lloyds, you are looking at investing while structurally it has turned positive. Let's talk about a couple of other segments as well. The ECD business, that showed a strong growth for almost 20.5% as well because of small domestic appliances and strong growth in fans as well. And this at the time when you've also tied up with a company, Jumbo Group, for kitchen appliances in the UAE. Wanted to understand the scalability of this vertical out here. How big are you expecting this business to be going forward?
Well, if you look at the fans business, which is a large part of this business, structurally, we believe that it is, highly penetrated category, but there is premiumization happening in this business. There is a high degree of newer retail as well as the online business which is coming up. Exports is a big opportunity. So overall, the ECD, if we think, and small domestic appliances, our market shares are still small, and we can gun for much bigger growth there. Other than that, there are other segments in electrical consumer durables, water heaters, where we are the leaders in this business. We have the air coolers, which is also a fast growth business. So we believe that ECD has a good potential for growth in the coming times. Last couple of years, because of consumer demand, it has been a bit tepid. But I think going forward, ECD will register good growth.
Okay, all right. Mr. Gupta, in the cables and wires business, the growth was a little bit lower actually in comparison to a nearest peer, Polycab, which we just spoke to. But as per you, what kind of a market share shift was there? But from here on, I'm looking at a couple of brokerage roads, and they believe that you're perfectly positioned now to go ahead and pull back a good amount of market share, because your emphasis on R&D, digitization, brand positioning as well will help you on that front. So where's your market share and how do you see it headed?
Well, overall, if you look at cables and wires segment, we have underground cables where we do believe that the new capacities coming up at our new facility in South will help us gain market share. But also, a sizable part of our business also comes from the wire segment, where it's a residential product, and the uptick in the real estate demand should help us grow in that segment. So we are looking at higher growth as well as market share expansion in cables and wire segment. Of course, when we are talking about the digitization, the overall R&D efforts, that's for the entire business of Havells and Lloyd, and that's continued investment. We believe that we are the highest spenders of R&D in our industry. We have a large base of R&D engineers of over 800 people. So with that, investments will continue in the entire business.
Right. So finally, before we let you go, we're first quarter in this financial year, in the middle of the second quarter as well. You have the visibility for pre-festive buying and all the other things that are happening. If you could give us a total roundup of what is it that you're looking at in terms of volume and revenue growth for at least this year across all segments, and what would that mean in terms of increased ad spends as well, which have been higher than what we saw on an average in the last 4 years rather?
Well, we usually don't give guidance, but on a general basis, I would say the first quarter has been a strong quarter. And with that, we are quite hopeful for the next few quarters to be a stronger growth for the business. And that's why we'll continue to invest in our ad spends. And, usually they remain between 3–3.5%, and that'll continue in the coming times as well.
All right. And you obviously have expanded manufacturing capabilities and looking to spend a lot more on capacity enhancement as well. But that's all the time that we have on our show today, Mr. Anil Rai Gupta. We will keep continuing our conversation as we speak every quarter, post your numbers as well, and get in some more details on this CapEx plan and what you anticipate in terms of growth coming in from here as well. Wish you and your team a very good luck. Right, let's get you some ideas for profit coming in from our colleagues at Money Control Pro now. Neha Dave joins in with a stock that she's been tracking.
Today's stock idea is State Bank of India. SBI's operating performance has been very strong, and the bank managed to deliver return on asset of about 1% in FY24 despite huge one-time expenses. Loan growth has been healthy for the bank, and deposit growth has lagged advances growth, but which is in line with the industry trend. While there are concerns over weak deposit growth in the banking system, SBI is relatively best placed with credit to deposit ratio, that is CD ratio, at 68% as of March end, which is significantly lower than the banking industry's CD ratio. Moreover, SBI carries excess SLR investment in government securities amounting to Rs 3,70,000 as of FY24 end. Management has guided credit growth in the range of 13 to 15% in FY25 and expects margin to remain stable. Asset quality has been trending better for the bank, and its slippage ratio fell to record low in FY24. While further improvement in credit cost is unlikely as it is already on a lower side, future earnings growth will be driven by better operating efficiency. Cost to income ratio can moderate going forward as wage expenses will normalize. Now talking about the valuation, the bank is trading at around 1.3 times core book value estimated for FY26, which is reasonable considering that return on asset is above 1% and return on equity has touched 20%. While earnings growth will normalize in FY25, stock upside will be driven by expansion in valuation multiple. Long-term investors wanting to play rising economic growth and picking off interest rate cycle should keep the stock on their radar.
Okay, all right. Thanks a lot for that. Well, for the time being, we slip in a short break. But on the other side, we have the management of Karur Vysya Bank, who's waiting for us. Stay tuned. Welcome back. You're tuned into Chartbusters here on CNBC TV18. Well, the next company on our radar is Karur Vysya Bank. The lender reported a good set of numbers. To help us discuss what went on in the past quarter and what's the way ahead, we are joined by Mr. B. Ramesh Babu, who's the MD and CEO of the company. Hi, Mr. Babu. Good morning and always good to see you and sir on the show. Well, let's get a couple of basic numbers first out of the way. What is the loan growth you're aspiring to grow in this year? As well as if you could tell us what is the margin trajectory from here on?
Thank you very much. Good morning to all of you. The loan growth, what we have guided during last quarter for the whole year is around 14%. So though it can go up pretty well, because we thought that the deposit growth may be contained. So that's why to balance between the deposits and advances, we thought around 14%. But we made some sort of a structural changes within the loan growth. So we have moved more towards the RAM vertical, wherein if you can look at it, this quarter also, on an average quarter on quarter it is 6%. It has come that way. Year on year also 20%. Where the yields are better, it's granular and more secured. So that's why rather than focusing on the corporate, we have moved towards the retail RAM, that particularly agriculture as well as retail and MSME, that's going well. And coming to the margins are concerned, we gave an indication that the first 2 quarters, we will try to maintain around 4% plus. And I'm happy to share that this quarter we are at 4.13 and the trajectory we propose to maintain. But at the most, even a worst case scenario, it comes to when the rates come down from the RBI side and the deposit rates will have to go up. We thought that the worst case scenario, it will land at 3.7 by the end of this quarter. So that's why on an average around 3.8 for the whole year, we will be able to maintain, if at all those things happen.
All right, we take that point. 14% loan growth and around 4% NIMs for this year may, for the entire year, be at around 3.8% as well. But, you know, you spoke about growth coming by via your RAM portfolio. What's interesting is that structurally, you've reduced your corporate exposure from close to around 45% of your book. You were looking to target it to be around that 20-21% odd itself. So for this year itself, if you could break up that loan growth into how much will come in from RAM and how will all your other parts of the portfolio perform, including unsecured?
Yeah. Unsecured, let me tell you, it's a very minuscule portion. It comes to around 2.5% of the total book. Even if it grows also, at the most, we may grow up to 5%. So that's a major portion of the unsecured. Coming to the RAM, so our intention is as it is to 80-20 to maintain that. So corporate at the most may hover between 18 to 19% and rest will be RAM 81. Out of the RAM also our preference is major to the commercial. So where we have a lot of presence is there in the area where we are operating. The margins are also much better there. Next comes the retail and next comes the agriculture. These three will work in this order and the corporate actually it is around 18 to 19% we would like to maintain a part of our portfolio.
Got it. All right. Sir, if you could tell us the quantum of the technical write-off pool and the expected quantum of recoveries that we can see from here on?
The technical write-off pool, it's absolutely, if you look at it, sometimes it's a deceptive number. The reason is when the industry was growing, projects and all these things, lot many loans were given 2012, 13 and all. Those things, if you go to various courts and other measures also, the recovery may be around 5 to 10%. So that way, those big accounts, the recovery percentage may be pretty low. So that way, as it is, if you can see the recoverable portion of the technical write-off, if you look at it, it comes to around 2,500 crores we can think of. So we have made a lot of efforts into that one. That is the reason this year you are able to see some sort of a good growth. Last year also, technical write-off pool has given a good number, and we feel that next 1 or 2 years, these numbers will be pretty good because internally, again, structural changes we have made and a lot many measures we have taken to get the money from these pool and all. So the next 2 years, we feel a lot of flow can be expected from that.
So you're saying the recovery will be around 2,500 crores, is it, from the technical write-off?
No, I'm talking about the pool will be 2,500 crores, which can be recovered.
And 5 to 10% will be recovered.
Correct. No, on an average, around 400 to 500 crores per year can be recovered in next 2 years.
All right. Got that. Take that point. And finally, before we let you go, let's wrap it up with some of the, asset quality and ratio sort of guidances that you earlier would give. I remember you wanting to take your, ROAs up to closer to 1.7%. You've achieved that. Where does that go from here on? And even the asset quality, you were looking at NPAs less than 1%. You're way less than 1% now as well. So your asset quality guidance, ROA guidance, along with the annual slippages and credit cost guidance, if you must.
I agree with you, but 1.7 for the quarter. But there are many unknowns are there in the coming quarters. That's the reason we gave a guidance of around 1.65 for the whole year. So NPA, net NPA is also we are at 0.38 now. That's why we said that below 1% we will be maintaining that one, though it will be in these ranges. But Mangalam, if you can look at it, last 15 quarters, more or less what we have guided, we are on track as per the guidance. Not only on one parameter, business growth, profitability and asset quality. We were at 0.32 ROA in 2020. Now we are at 1.7, which can be sustained. So that's why what we did is, instead of ups and downs going on, we wanted to sustain the entire growth what all is coming up in all three parameters. That to some extent we could succeed.
All right, we take that point. You have been guiding for a certain number. More or less, you have not only met that guidance, at most occasions you've also beat that guidance, and you maintain that guidance so that you can perhaps sustain it at current levels, taking into account all the vagaries of uncertainties that may come by as well. Wish you all the best for the next financial year and hope to speak with you in the next quarter as well. That's the management of Karur Vysya Bank. Let's take a short break, come back, focus on the markets and a lot of stock-specific action on the other side.
Welcome back. We moved to the low point of the day, which is actually something that we're not really used to. The markets are down close to around 130 points. The Nifty Bank is down close to 300 points. The problem pocket is the broader markets, though, because the mid-cap index is now down close to around 2%, and you have only 350 stocks that are trading in the green. Well, we've run out of time on this show of Chartbusters, so we'll wrap up. That's it from Mangalam and myself, but the team of Trading Hour will take all the action forward.